Hello, hello. Good afternoon. Thanks for joining us today to chat more about RSUs. I'm just going to give everyone a couple more minutes to join, and then we'll kick things off. All right. I see a couple more people trickling in, but at least we can kick things off so that you all can leave a session knowing a bit more about RSUs. So just to start off with a couple quick intros, my name is Laura Moreno. I'm the co-founder and chief tax officer here at 15th. 15th is a modern tech-forward tax firm for individuals like yourself. We're specifically focused on tech employees, tech founders, tech execs, VCs, investors, and have worked with thousands of employees to help navigate their equity decisions. I will pass it over to Jason to give him a quick intro of himself.
Hello, I am Jason. I'm an equity advisor here at 15th. I have dabbled in financial planning and tax and have advised thousands of people on their equity. So excited to dive into RSUs and demystify them and answer some good questions that you all have.
Perfect. Thanks, Jason. And you can see there is a Q&A button here that you should see on your screen. Feel free to throw in any questions in there. We will be answering all questions at the end. But as things pop up, feel free to make use of that button. So let's dive in. What are RSUs? RSUs, also known as restricted stock units, are a form of compensation granted to employees, just representing shares in a company that have to meet certain vesting requirements. Once you meet those vesting requirements, that's when those shares are yours to own and you can hold or sell as you see fit. Now, there are three milestones that I like to chat about when it comes to RSUs and just breaking down what that means for an employee and what are some of the tax considerations. So, of course, when you join a company and you receive an RSU grant, in this grant, you're usually finding a lot of information, how many have been issued to you. You might see a value. You might also see the vesting requirements, whether it's time-based or something more. We're going to dive into that shortly. So a lot of information. Most companies do have a one-year cliff. So in that case, nothing would happen at grant until you meet that vesting requirement or that one-year cliff when you first start. So grant is helpful. You get a lot of information, but nothing to worry about tax-wise. When you vest is when that's when you really need to be aware of the potential tax implications. Now, there are two types of vesting schedules. I'll call them single vesting and double trigger vesting. And that's single trigger and double trigger have different requirements that you need to meet. But in both cases, you are vesting. And when you vest, that is what is triggering a tax impact, a tax liability. I really think the biggest thing, and we're going to dive into this a bit more later on in the presentation, is that most shareholders are in the set it and forget it mentality. And when it comes to RSUs, since you're paying on the fair market value at vest, there is a decision that all RSU holders should make. Should I hold or should I sell? And this is something we talk to a lot of clients about, and we'll dive into a bit more here. The other really important call out here is with a lot of RSU holders, if you are changing residency as you are vesting, that can trigger different state tax implications. So it's really important to be aware of where your location is as you vest. Just because you leave a state does not mean you're never going to pay taxes in that state. RSUs do have some clawback treatments here. So again, something that we work through a lot with our clients. And then maybe the most obvious taxable event for our clients is a sale. So there is going to be a taxable event here. The sale or the tax impact, that capital gain, will be the difference between the sales price and that vesting fair market value. It's that difference that could trigger a potential tax obligation. So let's talk about these vesting schedules that we see with a lot of tech clients. The first is going to be the most digestible, single trigger vesting. And this is what most clients are used to seeing, time-based. If you meet this amount of time in a company, you will get this many shares. Once those shares vest or hit those time requirements, you will get the shares and they will be yours to potentially sell. But again, it's that vesting requirement that triggers a tax. We see most often that single trigger is offered by public companies. So that's just an important call out. There's also on the flip side something called double trigger vesting. And this is, but you have to meet both a time-based requirement and some sort of liquidity event. And this usually looks like an IPO or an acquisition. Most private companies offer double trigger vesting. And the reason being is that when you vest RSUs, you have a taxable impact. For private companies, you don't have the ability to sell whenever you want to help pay for those taxes. So most private companies do follow a double trigger requirement. That way, employees are not on the hook to pay taxes when they have no opportunity to sell their shares.
And if you have double trigger RSUs, if you're at a private company, it's really important to read through your grant document to see what happens if you leave the company before both vesting requirements have been met, because it can vary. And since there are two vesting requirements technically, it's going to be a really important piece of the equation when you're kind of considering potentially leaving a company.
For sure. Awesome. So let's talk a bit more about the RSUs and that vesting. We talked about that there's a taxable event at vest. So what does that mean? So when RSUs vest, the fair market value on that day is treated as ordinary income. Ordinary income is just another word for income types like salary or bonuses. So this is subject to all the same taxes as your wages. It's subject to regular taxes. You're also subject to payroll taxes on this income. You'll see this income reflected on a pay statement, will also be reflected on a W-2. So if we look at an example, let's say you had 1,000 RSUs vested on March 1st. On March 1st, the stock price was $50. You'll see an additional $50,000 added to your pay statement and your W-2. Now, the tax is pretty digestible for most clients to understand, but the biggest pain point that we see clients struggle to understand is the withholdings. So if you are an RSU holder, we've seen a lot of RSU holders get very anxious about filing their tax returns because when they file in April, they find they have a large payment due, and they can never truly understand why that is. And this is the exact reason. RSU income in the eyes of the IRS is seen as supplemental income. What that means is that there are flat withholding rates on this income. So it's 22% withholding for federal purposes on the first million. Anything over $1 million will be at 37%. Of course, you have state taxes come out, Social Security, Medicare. So all in, when clients are going through these vesting transactions, they see, okay, well, 40% was withheld. So I think I'm good. But they don't realize that only 22% of that 40 actually went to the IRS. The rest went to state and payroll taxes. So again, there is this delta that can happen that can trigger additional taxes with the filing of your tax returns. So let's get into an example so you can see what this looks like in real life. So let's say Sophia is a California resident. She hit a vesting milestone, triggered $50,000 dollars of RSU income, and let's say her effective tax rate is 30%. If I go through the calculation for her RSUs, 50,000, you'll see for federal purposes, 22% will be withheld, and that equates to 11,000 of federal withholding. Now, if I take a step back, her effective tax rate is 30%. So on that $50,000 of RSU income, it will trigger a federal tax liability of $15,000. You'll note that her withholding on this is $11,000. So she will need to pay an additional $4,000 when she files her taxes, files her tax returns. And this is the exact example that we see a lot of clients go through, especially with our RSU holders, this true up of taxes that they actually owe versus taxes that were withheld. And you'll notice the main driver here is this effective tax rate. So let's dive into a bit more on what this means. I think a lot of our clients, when they think of tax rates, they think of marginal tax rates. And I just want to double click on this effective tax rate because I think this is going to be a bit clearer in helping you figure out what that potential shortfall could be for you. So your effective tax rate is taking your total federal tax and dividing it by your taxable income. Think of this as your true average tax rate. Marginal tax rates, as you see on the tax rate schedule here, you have 10%, 12%, 22%, and think of every bucket taxes up to a certain amount of income. So just because you're hitting the, 30%, 32% tax bracket doesn't mean all of your income is taxed at that rate. Only a piece of it is. So think of your effective tax rate as a blended average of all of the buckets you're hitting. And this would be the percentage to compare against the 22%. So we talked a bit more about vesting. We talked about withholding. Let's now turn our attention to selling RSUs and what that means. So after you vest, again, you get to this point of now these shares are yours and you can either hold or sell them. If you choose to sell them at a later period and there's appreciation that occurs, that's when you would trigger capital gains tax. And again, I always recommend our clients review their shares and the related values every time they vest. It's so easy to set it and forget it. But if you have RSUs vesting and let's say on that date you believe the fair market value is very high, you're paying taxes on that full value. If you think there isn't going to be significant appreciation, it might not make sense for you to hold on to those, right? But if you think your RSU is vested at a low point and you think there's only, there's a tremendous opportunity for upside, then yeah, maybe holding on to those and letting that appreciation ride and banking in long-term capital gains tax is going to be helpful. But having these discussions with a tax advisor as you're vesting, I think is just a great way to evaluate your investment. I mean, that's what it is. But again, out of sight, out of mind, a lot of our clients forget about it. And then they feel like golden handcuffs trying to figure out how to navigate some of the capital gains tax that they've accumulated over time. And yeah, just to call out how the capital gain is calculated, you're taking your sales price and you're subtracting your cost basis. And your cost basis is the value at which your RSUs vested. So if we look at an example here, let's say Sophia's RSUs vested at $50 a share, and let's say she sold them for $100 per share. When she vests those shares, that $50 will be included in her W-2, in her pay statement, and will be taxed at vest. If she holds on to those shares and sells them, that spread between the $50 and the $100, that's going to be that's what's going to be taxed at sale and will be a capital gain. Now, there are two types of capital gains: short-term capital gains, long-term capital gains. long-term capital gains are taxed at lower rates. If she held on to those shares for a year, that's when a year or more, that's when the long-term capital gains rates would come into play. So let's talk about reporting. This is another really big pain point. A lot of these sales, all of the sales, are reported on something called a 1099-B. And it's really important to call out that these 1099-Bs in normal circumstances do report transactions. They report sales, they report the property, they report the proceeds, the cost basis, and the related capital gain or loss. For RSUs, that cost basis is tied to how much was included in your W-2, in your pay statement as wages. Financial institutions don't always have visibility on that cost basis. So you might see a zero in there. And that's usually a huge red flag for us as tax preparers that they did not report the cost basis. So you need to make an adjustment on the sale of your RSUs on your tax return before you file. What we find is 1099-Bs, especially for those customers that have brokerage accounts, these are tax forms they see all the time. They didn't even realize that there could be a mistake on these tax forms. So this is certainly something to review and make sure you're reporting correctly on. Ideally, I highly recommend working with a tax professional. Plug for us. I hope it's us, and I hope you come work with us, since equity compensation is our bread and butter. But really making sure that you're reporting everything correctly here is super important. And for our clients too, we do look back at previous tax returns and we find mistakes in those as well, and have gotten them refunds as a result because they didn't report any cost basis on these sales. Great. So I guess just to think about takeaways with RSUs, the first is going to be withholdings may not be enough. So cash planning is definitely important as you're vesting RSUs. Working with a tax professional to understand the tax implications and what the shortfall is now will give you transparency and will give you time to cash plan for April. Of course, reviewing your RSUs as they're vesting throughout the year, making a really deliberate decision on whether to sell or hold based on where you think the company is going to go and where the performance of that company is going. Of course, if you think the value is high and you don't think there's going to be any more upside, you may consider selling immediately at best. So, but again, all discussions that you can have with your tax professional. And then the third biggest takeaway, sales can be reported incorrectly on tax forms. So really making sure your cost basis is right on these tax forms. Again, not all financial institutions have access to the wage data that's required to figure out your cost basis. So definitely recommend having a tax professional review the 1099-B and make any proper adjustments on your tax returns. And then, of course, a shameless plug for us, how we can help. Again, equity compensation is our bread and butter here. This is the population that we focus on the most. So we can advise quarterly on what this means for you as you're hitting more vesting milestones. We do offer flat fee pricing, which includes the preparation of your tax returns, access to our tech-forward platform, as well as year-round tax advisory. So if you do go to our website, there should be a talk to an expert button on the top right, and you can schedule an intro call to learn more about how we can work together. All right, that was a lot of talking. I'm going to pause here for some questions. And I think Jason has some questions that have been coming in that I can let him dive into.
Yes, most definitely. Perfect. We have some great questions. First question that came through is related to double trigger RSUs. So the question is, for double trigger RSUs, assuming the time-based vesting condition has already been met, when is the tax liability actually incurred? A, at the time of the liquidity event, or B, given an IPO or public listing after the lockout period ends? And that's a great question. And the answer is it's going to depend. There are a few different scenarios that will impact this potentially. So with double trigger RSUs, one of the key things you'll want to look for is the company will officially call, or they'll say it's called settlement. They'll settle the RSUs. And when those RSUs are settled, that's when the taxable event occurs. Now, the company can technically choose when they want to settle the RSU. So in some cases, that can be right at IPO. In other cases, it might be after the lockup period ends. I've also seen some cases where there are they will allow employees to sell certain percentages at different windows during the lockup period. Like, a month in they can sell 20%, and then after 6 months they can sell the rest. And so the company will ultimately make the decision on when those are settled. So it's something to look for, when your company is going public. Usually the S1 will indicate it. So Circle just went public recently. Their RSUs, they settled at IPO based on the S1, which means that a lot of those employees, it's great. They have some really, really big capital gains to plan for now. But yes, it's going to depend ultimately on when those RSUs are settled. Great question. The next question that we have, and these two kind of go hand in hand, how to save on RSU taxes and then general tax preservation strategies. So unfortunately, with RSU income, it's considered W-2 income, and there's not a magic wand you can wave to reduce your tax liability. There's not one big thing you can do, but there are a bunch of smaller, I call it lower hanging fruit items that you can address. First one is if you have access to a 401k from your employer, which if you're at an employer with RSUs, most likely you do, take advantage of the pre-tax contribution amount that you can make. It's $23,500 for this year. That's directly going to reduce your taxable income. If you have a high deductible healthcare plan, the HSA is great. If you have a family plan, you can put $8,550 in that, and that's going to directly reduce your taxable income as well. If you itemize your deductions, you could consider making charitable contributions. If oftentimes with people who have RSUs and they're double trigger and the company goes public, they have a really high income year. So you might consider lumping contributions into what's called a donor advised fund and getting a bigger deduction in the year that it really matters. It's a strategy we use all the time. Those are going to be kind of like the big three things. Depending on your employer, you also might have access to something called a mega backdoor Roth 401k. It's not necessarily going to save you money on taxes this year, but there's some strategizing you can do with kind of using RSU income to live on and funneling as much money into that after-tax 401k as possible. Depending on the state you live in, you might have a deduction for what's called a 529 plan. It's another great way to potentially save on state income taxes. New York has one. It's a $10,000 deduction. California doesn't, but all the states differ. So those are a few things that you can do, but unfortunately, there's not another big magic wand we can wave to make the taxes go together or go away. Just a bunch of little things that we can do to really optimize. I guess the last thing I didn't mention, if you're in a situation like Circle employees where you have a bunch of short-term capital gains from your RSU income now, tax loss harvesting is going to be a really big one. So taking your regular portfolio, harvesting any losses that you can to offset those gains. That's more of a niche situation, but that's where we would work hand in hand with a financial advisor who's managing investments. And we would say, hey, there are this many gains. It'd be great if you could do some harvesting to try to offset some of those. Perfect. The next question that we have is things to think about when selling RSUs from concentrated stock positions to lower your tax bill. So in this situation, I assume that you mean that you have a bunch of RSUs that probably have some built-in gains. Few things that you can do to try to reduce your tax bill in that scenario. First one that I just mentioned, tax loss harvesting, again, is going to be really important. The other big thing that you could do in that situation is you could actually look to donate some of the RSUs, put the appreciated RSUs in a donor advised fund. You get a deduction for them on the value of the date that you put the RSUs in the donor advised fund, and you don't pay capital gains tax because you're not actually selling it. So it's kind of like a double win there. Those are going to be two of the really big things that you would want to do to try to reduce some of your income and your tax burden there. Perfect. Let's see. I have some others. Another question. So we kind of went over this already, but when do I owe taxes on RSUs at grant or at vest? You'll owe taxes at vest if it's double trigger. Then when the time-based vesting requirement is met, there won't be any tax. But when the liquidity requirement is met and there's settlement, you will owe tax at that point in time. A common thing, this is just like something that I hear all the time is, and we touched on this in the webinar content, but people often say 50% of my RSUs are being withheld, but I'm still owing taxes. I'm being double taxed on these, or I'm really owing a lot of tax on this. If you're someone who is in New York, particularly New York City, this is very common where you'll see that you've got close to 16% being withheld for state and city tax. You've got payroll taxes, and then you've also got federal income tax that's being withheld. So that's something to look out for. That's kind of a big gotcha. The other thing to note sometimes on when that comes with tax withholding, some larger companies, and we're seeing it even more with like not as large companies, they will let you adjust your tax withholding on RSUs. So if you are comfortable with selling more of the RSUs, you can have that 22% increased to 37%, or sometimes they'll let you choose a different value. But that's also something to look into. You can ask your company's payroll department, or sometimes it'll be in your equity platform where you can see if you are able to do that. Next question I have here is, how are RSUs different from stock options? So incentive stock options or non-qualified stock options. And that's a really great one. Big thing to kind of start out with is stock options are typically issued by companies that are earlier on and are private companies. With a stock option, you have to exercise the option. You have to pay to purchase shares of the company. So at grant, you'll be given an exercise price. And when you exercise, it's a taxable event. The tax depends on the type of option that you have. With an RSU, you don't have to pay for the share. It is given to you, and then you pay tax on the value of it. So that's the big difference. Is RSUs, it's kind of like a cash bonus, but company stock is what you're getting. With options, you're buying shares of the company with your own cash. And options, you do have a little more control over when the taxable event officially occurs. The last question that we have here is, can RSUs qualify for QSBS, Qualified Small Business Stock, or long-term capital gains tax treatment? And good question. So long-term capital gains treatment, if there's appreciation after the shares officially vest, any of that appreciation can be a long-term capital gain if you hold on to the shares for more than a year before selling them. QSBS, so if you have restricted stock RSUs, if you were given them and they vest and they're single trigger, when the company is still considered a qualified small business and you meet the 5-year holding period, then yes, they could potentially be considered qualified small business stock, but it's a little more niche. It's probably less likely to happen because RSUs are given by companies that are usually no longer qualified small businesses. And QSBS, I guess I should mention, if you have shares of a company and it's a qualified small business, big thing is $50 million or less on the balance sheet. You purchase those shares and you hold on to them for 5 years or more. There's a $10 million exemption that you can get at the federal level. So $10 million of gain could be tax-free potentially. So not as big with RSUs, but something that we certainly see with options, and definitely a reason to talk to a tax advisor. Perfect. Well, I think that is everything that we have for today. Really encourage you, if you need support, email us at hello@fifteenth.com. If you have friends that you know are going through a liquidity event or have complicated tax questions, let them know. Tell them about us. Tell them to come have a conversation. they can have, a call with us and see if we might be a good fit. We are happy to help. I know there are a lot of things happening in terms of tender offers, secondary sales, IPOs, and all of it can be complex and confusing. But really appreciate everyone for attending our webinar today.
Perfect. Thanks again. And yeah, we're here if you need us. Feel free to reach out. And check out our resource center on our website if you want to learn more about RSUs or stock options, secondary sales. We're really creating something robust over there. So definitely, yeah, if you want to read up more on equity, we're here. All right. Thank you all.
Thank you.